I have a big mission of decreasing the wealth gap by $100 billion. We have $2.1 trillion in spending power. It's like, okay, well, the money's going somewhere. Investing in yourself, becoming a person of value. There's no cap on that. Make, manage, maximize. I call it the wealth triangle. And that's where you make your money. Wealth is made through concentration. It's preserved through diversification. We've been able to outperform the market consistently for years by following that strategy. Keep your lows high and your highs low. To me, brand is not your colors. It's not your logo. It's being known for what you do.
Becoming world-class at something, what does that look like?
How can I be the best at what I do? And if you do that, you become world-class. If you do that, making money will not be an issue. Well, how is your money gonna make you money if you're not making money?
I hope you guys are excited to get into this episode. Don't forget, if you would like to purchase an investment property in Dubai, make sure to fill out the form below and book a free consultation with me. Welcome to the Building Wealth with No Borders podcast with me, Lamide Elizabeth, where I'll be bringing you guests from around the world to share their strategies on building wealth. And today we are in Atlanta. We're in a whole new continent to bring you some of the best guests to just learn from them about building wealth. So I'm so excited. And today we are in Atlanta with award-winning financial advisor and founder of Melanin Money, tongue twist, and CapitalWize, George Acheampong. Welcome to the podcast.
Thank you for having me. And one of the few times my last name actually gets said the right way.
I'm good at this stuff.
Of course.
No, in the UK, we have a big West African community. So yeah. I'm used to the Ghanaians and the surnames.
Yeah.
But let you introduce yourself as well to the guests.
Sure. So as you mentioned, George Acheampong, founder of Melanin Money. And I've been a financial advisor and wealth manager for 13 years. So I've got a chance to see a lot evolve in the space as it relates to just trends in the market and investable opportunities. I have a big mission of decreasing the wealth gap by $100 billion by helping 100,000 people of color achieve their first or next 1 million in net worth.
I love that. So we've had quite a few financial advisors on the podcast from the UK, from Dubai. And what I'm really excited to hear about in this conversation is how maybe you as an American financial advisor, how some of your advice might differ. If it does, I'm not necessarily expecting it to, but there probably could be some differences. So I think that's really going to be really interesting. And you've won a couple of awards for being, a good financial advisor. So I'm excited to get into that.
For sure.
But before that, I always try to understand a little bit more about how the guest has kind of like grown up in relation to wealth, in relation to money. Yeah. So can you speak to us a little bit more about that?
Yeah, well, I certainly didn't grow up with money, for sure, which kind of sparked my desire and passion to learn a little bit more about it. So I think my first interest was, funny story, I remember it was Christmas. I'm not sure if Christmas is big where you're from. But
why do Americans say that?
Is it big?
Of course, it's Christmas.
you don't know.
It's a Christian country. Well, secular, but Christian country.
Fair. So I remember one Christmas, I wanted a PlayStation. Well, at the time it wasn't PlayStation 1, it was just the first PlayStation. And I told my mom at the beginning of the year, I was like, I want this PlayStation. And then in my mind, because she didn't say no, I just knew I was going to get the PlayStation. So I look under the tree, I see a box that looked like it was the shape of a PlayStation. I just knew I had the PlayStation. And I opened that box on Christmas and it was tube socks.
Ew.
It was tube socks with the little red lines at the top. Now, in hindsight, I didn't know. My mom just didn't have the financial resources. And in her mind, she probably thought that she would have been able to figure it out between January and December, right? And so at that point, it sparked something for me. I was like, well, if you want something in this world, you got to get it yourself, right? Mm-hmm. And so I started to, do odd jobs, cut grass, help my uncle wash cars, but I wouldn't spend any of the money. I would just keep all the money. And then to the point where my family started to knew I had money, even though I was in elementary school, and they would ask to borrow money. And I didn't know what the term interest was, but it just seemed logical that if I give you some money, you should give me more back whenever you give it back to me. So I was a loan shark at the ripe age of, I think, 11. But anyways, that kind of sparked my interest for just wanting to be a better steward over financial resources. Fast forward, I go to college, my mom gets remarried, and she knows I've always kind of been this, financially savvy kid. And she said, hey, can you help me and my soon-to-be husband put together like a budget or a cash flow plan? At the time, I just popped some stuff in a spreadsheet, try to make it organized, make sure they had a good plan. And I had a friend that was interning for a financial services firm and said, hey, is this something like what you guys do for your clients? He said, we just care about helping them invest. We don't care about their cash flow. None of this. This is actually really good. Mm-hmm. Now, at the time, I didn't think nothing of it. I was double majoring in marketing and economics. Okay. And so I just, it was just kind of a thing that I remember kept in the back of my head that, okay, I'm going to be good with money. I can help other people with it, but not pursue it as a career path. Long story short, I graduated in the middle of the recession. Marketing was viewed as a luxury. And so I decided to pursue my economics degree because the financial industry was the one that caused the recession in the first place. And there were plenty of jobs. So that is how I kind of got my start or spark for interest in the financial services industry. And then Fast forward a few years later, became an advisor, wanted to impact more people, started creating content, and I guess the rest is history.
I love that. There's so many similarities or things that I can relate to. Christmas, when I was growing up, majority of the times was a bit of a disappointment. But it is what it is. But also, I was definitely the lender in my house as well. I used to call it the Bank of Lambs. I was always lending out money. And I think one of the things it taught me, because I later went on to, I worked at JP Morgan, I worked in credit. I think one of the things it taught me was like, dealing with creditors and bad creditors, because a lot of the people who used to borrow money from me, my mum being number one, I would never get that money back. I would not get that money back. So immediately as she would borrow some money, I would just write off as like, this is bad debt expense. I might get a little bit back, but it's unlikely. But yeah, so that's definitely relatable. So in terms of pivoting, so you started in marketing. So when did you actually make the pivot?
Yeah, so I interned for Coca-Cola when I graduated. And then I had a friend, like I said, that was interning. At the time, he was working for a financial services company. I just was kind of getting bored with what I was doing at Coca-Cola, because what happened was when I graduated, they were going to keep me on as an intern, but they weren't going to promote me to the marketing manager role I was supposed to have. And so I was like, well, I have real bills now. I have student loans. I can't stay in this intern position. And so that's when I made the pivot to the financial services industry. It was around 2011, I want to say it was.
Okay. And did you go in as an advisor? Did you just work in finance?
I started out on the risk management side with Mass Mutual. So I got all my insurance licenses first.
Okay.
And then I transitioned to the advisory side and then ultimately started my own firm because they had me do this exercise called Project 200, where basically it was like, write down a list of 200 of your top friends, family, colleagues who you want to make clients, but they had to have a specific criteria. And I didn't know anybody that really came from money. So it was kind of this dichotomy of, do they not deserve access and understanding to building wealth, right? And I feel like if I did that, then I would just perpetuate a narrative of our people that look like us continuing to not build wealth. So I was like, I have to create something to where I can serve people that look like us, bridge the gap, meet them where they are, also still building a business that I'm proud of. And so that's why I decided to start my own firm. Okay,
so you started in marketing, then you moved into a little bit of insurance.
Yep, risk management first.
Risk management. And then you moved into financial advisory. But there, they were basically saying they only wanted to serve a certain clientele.
Exactly. Certain level of net worth, certain level of income. And had that not happened, I probably would have stayed there for a lot longer. But I knew that I wanted to serve people in different ways, right? I knew at the time, I even knew that I had some friends that were entrepreneurial and they were making good cash flow. They didn't have $250,000 of minimum investments, right? So it's like, okay, well, I'm making great income, but you're telling me I don't deserve to talk to a financial advisor. And so I had to figure out a model that would allow me to serve them on their journey to wealth accumulation, right? Versus expect them to already have it.
And how long did you serve as a financial advisor before you went out on your own?
It's a great question. It's about 4 years.
Okay. And what did your time in being a financial advisor at someone else's firm, what did that teach you about like money, wealth, the world?
Yeah, I mean, I think what number one, what it taught me is that you can be in business for yourself but not by yourself. And so I was able to kind of operate underneath their infrastructure, but I was able to still build my own brand, build my own book of business. So I thought that was cool. So now when I run into new advisors who have that same entrepreneurial spirit, I can let them know, hey, look, you can still build your business within the setup of another business, right? So it taught me that. In terms of just wealth in general, it taught me that the wealthy did things differently. It taught me that they prioritized infinite opportunities and didn't focus on finite ones. What I mean by that is budgeting and cutting expenses only can go so far, right? Like maybe you can get that down to zero, sleep on your mom's or your friend's couch, but then that's the floor. But focusing on infinite opportunities like investing in yourself, becoming a person of value, there's no cap on that. And so they were very focused on those infinite opportunities because they knew like the same person who's stressing out about a $3,000 credit card bill, they're like, well, just go make more money. Just become a person of value to where that $3,000 seems like $3. And they didn't let those things carry, I think, the weight that a lot of people let debt and those things hold over their shoulders. They don't care. It's like, hey, look, it is what it is. I'm going to focus on the things that really move the needle, and I'll be able to address that, and it'll be, a simple thing in the grand scheme of things.
I love that. I always say that there is a floor to how much you can cut back on expenses but making income, making more money is infinite. So I love that. So before you then transitioned into having your own businesses, how did you prepare yourself financially for that transition of having that security and then going out fully on your own. But I guess the thing with financial advisory is you're kind of self-employed, or like the business, you kind of drive the business, right? The business that you bring in.
Yeah, to be honest with you, so when I was working with the other firm, it was still like 100% commission. There was no base salary, right? So I kind of went into it kind of entrepreneurially, if you will. And so that kind of gave me the first line. I remember like it was yesterday. I was there for like 3 weeks or something. And I went to my manager's door, knocked on his door at his office. I said, hey, just checking in. I didn't get a direct deposit. Do you guys get physical checks? It was like, you get paid when you bring in new clients. So and I don't know how I missed that connection point when I went through the interview process. I was like, you mean to tell me I only get paid? So I say that to say I learned a very valuable lesson. Keep your lows high and your highs low. And what I mean by that is, as an entrepreneur, 1 month you can make $20,000, right? Another month you can make 20, just depending on how the month goes, right? So you have to set your baseline for your personal lifestyle to make sure that regardless of what ebbs and flows happen, there's enough cushion there to absorb that. So for example, in this context, let's say 1 month I made $20,000, okay? But my personal lifestyle, I want to keep it at around $4,000 to $5,000. If I don't make $20,000 the next month, it's not that big of a deal because I didn't spend the $20,000. Oftentimes what happened, and what I see a lot of entrepreneurs do, is before their income becomes predictable, they think it's always going to happen like that. They'll get a financial windfall and they'll spend as if that's going to happen next month or the month after that. And so most people are what I call bank balance entrepreneurs. And what is a bank balance entrepreneur? They log into their bank account, they see the money there, I can spend it. They're not forecasting. They're not thinking about what's coming out next. They're not planning. They're just looking at what they have. And if they have it right now, then they can spend it. And so it really taught me a valuable lesson on money management and understanding the dichotomy of managing your personal finances, keeping the lights on for your business, and also keeping capital for your business to grow. Because you want to be able to invest in marketing. You want to be able to go to like I'm sponsoring a few events this weekend, right? So like if I wasn't a good steward of my resources or I consumed too much personally, I wouldn't have those resources to reinvest back into the business.
So what was the cushion for you? How did you know that, okay, I think I have enough resources now to go out on my own? Or did you like build up your clientele whilst you were at the firm and then you took those people with you when you were doing your own thing? How did you make that transition?
It was a little bit of those two things. I built up my clientele. I was able to somehow avoid the non-compete. I don't even know how that happened. So I was able to take my clients. But also it was a little bit of just healthy delusion. Like delusional optimism. Like I was 23 at the time. And it was just like, I don't have any responsibilities really. I'm confident in what I can do. I have my licenses. And I just was really confident in my own ability. And so I think the combination of having a base of clients, I had a little bit of money. So I honestly don't think it was anything super meaningful. So I don't think my story would necessarily translate for what I would advise today. What I would advise today is making sure that you have at least, I would say 9 months of personal spending covered, because not only are you going to have to take care of the expenses of the business, but there's going to be things that come up and your cash flow is going to ebb and flow as you're getting started. You're going to have startup costs. So making sure that the business, you're not relying on the business to pay you for at least the first 9 months is what I would say. And that might even be conservative. Personally, that would be my advice today, because what I'm a firm believer in, if you don't have mental clarity or if you have this hidden drag in the background, you're not going to be able to show up as productively in your business, which is going to have an impact on how successful your business is. If you're worried about keeping the lights on personally, it's going to be very hard to grow your business. It's almost like my phone that was making a cameo a few minutes ago. It dies all the time. It doesn't die because I don't charge it. It dies because it has all these apps running in the background. It's the same thing with our brain. It's like, if we have all this unfinished business, all these things that we're thinking about, it's very hard to show up in the best version of yourself. People think there's a separation of business and personal, and it's not. I mean, you can fake it, but at the end of the day, if you have stuff going on personally, it's going to reflect in the business. So if your finances for your personal life are secure, I believe that the already hard journey of an entrepreneur will be a little less hard if you're not dealing with that in the background.
I love that analogy of the apps in the background. So you're currently kind of working on CapitalWize and Melanin Money. That's what you're currently running. What are those two things?
So CapitalWize is my registered investment advisory firm. That's where, all of the actual asset management, financial planning work happen. Melanin Money is the brand that kind of funnels people into the ecosystem, right? Because what I realized when I first started my firm, I told myself I was going to be the Netflix of financial advising, right? But the dot I didn't connect is Netflix is intellectual property, it's content. I was actually trying to serve hundreds of people for a very nominal cost with one-to-one services. I started doing the math. I was like, oh my gosh, I'm going to have 500 clients for this to make sense. And so I had to have a separation. I had to say, okay, I don't want to stop the mission of helping people at scale. And now we see it more popular with things like this, platforms with podcasts. Okay, cool. I I can be your mentor from afar, right? So I had to figure out a way where I could still have an advisory firm and serve clients that made sense for the context of my business while still having a platform that allowed me to educate and coach people at scale. So Melanin Money becomes that kind of initial funnel of like, we have our podcast, we do free master classes. We taught 30,000 people last year live over the course of 12 months. So that's the platform that allows me, if you're not ready to work with the one-on-one advisor, I can still help you. Because the best way to help somebody is to help them. And so I'm able to give them great insights, great strategies, great content for them to start doing some things on their own. And then if they get to a place where it's like, you know what? I'm ready to hire an advisor. That's what would happen. And they would then transition over to CapitalWize.
Did you ever feel like just niching down in, because if you're using Melanin Money as like the funnel to get people into CapitalWize, then I'm sure the majority, if not all of your clients are Black people.
Vast majority.
Did you ever get the advice that like, that's too niche or like you're restricting how much you're going to make because perhaps if you were serving another demographic, they in general, or they might have more people that have more money.
Yeah.
How did you think about that?
Yeah, I definitely got that feedback early. People were like, number one, I don't know if they even have enough money to be the ideal client that you want. And two, you're cutting off a large percentage of the population if you only serve those people, right? And my thing is, when you think about a business, right, you're not, at least my business, I'm not trying to serve the entire, even if the niche wasn't people of color and the niche was mechanics or the niche was consultants. A niche is a niche, right? And so for me, I know I wasn't trying to serve the world. I knew that what my target as a company was. And I did the research and I felt like I could still build a very meaningful business niching down on certain people that look like me, right? And also still having a way to meet the needs of the people who may not be ready to work with me one-on-one and still have a great business. So I did the research and I was confident. I know I definitely got that pushback and people felt like, oh, you're not going to be able to build a big business. They don't have investable assets. They're not like, I got that. But for me, I just was confident and I believe in my people, right? And I believe that once they were educated and empowered, they would want to work with an advisor. And I looked at the statistics of where the money was going, right? You hear all these stats all the time that we have, 2 trillion or whatever the stat is today, 2.1 trillion in spending power. It's like, okay, well, the money's going somewhere, right? We have to have
Is that Black people?
Yes.
Okay.
We have to just have a paradigm shift on how it's allocated, right? And I think where the paradigm shift comes is education. It comes with access. It comes with understanding. And I wanted to bridge the gap between the credibility of a financial expert and the relatability of a financial creator and kind of merge the two worlds together.
I love that. So you said that one of your goals is to reduce this racial gap by creating 100,000 millionaires. Okay. What's the game plan? How does one do that?
Yeah. So fun fact, in the last 12 months, our clients have improved their collective net worth by $244 million.
Oh, wow.
Which is all tracked and documented. We actually announced it at our event, Wealth Weekend last month.
Wow.
And so the plan, what's the big plan? So the big plan is, first and foremost, I think our firm has the capacity that stands right now within the next, let's call it 18 months, to serve about 1,000 clients, right? Now, that's a far cry from 100,000, right? In terms of the people we want to impact. So how do we get from serving 1,000 clients to being able to impact 100,000 people? Well, that's where Melanin Money's platform comes in. So every other month, we do a virtual summit.
If you're enjoying this content, please don't forget to hit the like button and subscribe. And if you would like to become an international property investor in Dubai or in the UK, the link to book a free consultation will be in the description box below. If you're not quite ready to invest yet, check out the affordable video courses that will also be linked in the description box below. And if you would like to relocate to Dubai, set up your business in Dubai, or anything else related to relocating to Dubai, check out www.theprofessionalnetwork.com.
Yeah, so, if we just did what we did last year, right, we'll teach 30,000 people, right, virtually. And we're not holding back. We're not gatekeeping, right? We're giving the top strategies, the same insights that we're actually implementing on our clients' behalf. Because the reality is, a lot of them may not be clients because we just don't have the capacity, or maybe they're not yet qualified, but they're still getting the advice and the insight and the guidance on the strategies that are helping our clients achieve that. So through mass education is one of the biggest ways that we're going to do it. And so that comes from the virtual summits. Then of course, working with our clients in our firm. And then the other pillar is transforming the industry. So the things I'm doing as an advisor I would say is not typical to our advisory space. Most advisors, they kind of sit behind a desk. They have a handful of clients that they serve and kind of call it a day. They're not marketing themselves. They're not doing education at scale. And so my goal is to say, since I know my firm can only serve so many people, how can I start advising other advisors to build their business in a way that's similar to mine, right? And then the last pillar of this is I fully expect that as our clients transition over this $1 million plus net worth mark, which we already see happening, they're now taking this insights and information back to their community. So it'll create a ripple effect. Now, will I be able to track every single person, right, within this movement? In the grand scheme of things, I'm not sure. But I know that when I go to InvestFest tomorrow, that I'll come across people that I taught that said, hey, I did this and it works for me. I'm well on my way. I'll come across clients that come to the event that have already achieved that milestone, people that have seen my content, and it creates this ripple effect of impact. Like I never fully expected that George and my business partner would talk and advise 100,000 people, but I did know that our movement, our system, and the way that we're building it would be able to impact that many people.
And so if you could just share, like, what are some of the things that you are telling these individuals that are coming into CapitalWize that are allowing them to go from whatever net worth that they are currently on to $1 million? So what are some of the key nuggets?
Sure. I break things down into three main overarching buckets. It's make, manage, maximize. Your first investment is, and I don't mean to be cliche, but it is you. And actually, I'll start with this. I call it the wealth triangle. And that's where you make you money. That's the first part of the wealth triangle. Like you have to become, in my opinion, world-class at something. Wealth is made through concentration. It's preserved through diversification, right? And most people, they hear these quotes about like making 7 streams of income and they lose sight of the fact that the richest people in the world, they became world-class at something. And then they were able to use the profits and the excess to invest in other things. And they were owners. The reason the title is founder and CEO. Founder represents the equity. CEO represents the job title, right? And so they take a lot of that money and they invest in other areas. But to the general public, it's like, oh my gosh, Elon does this and this and this. He invested in this and this, right? So become world-class at something. And then from there, you have the option to then transition that into building a scalable business where people and or systems make you money. The simple analogy I always like to use is a barber. Let's say I was a celebrity barber. I charge a lot of money to cut hair. But at the end of the day, there's only so many people I can cut in a day, right? The next natural evolution is to create a barber shop where now I have 10 barbers who can cut, whether I cut or not, I can still make money as a barbershop owner. So building something where systems and our people can make you money. So you go from you making you money to people or systems making you money. And then the last part of that is money making you money. And that's the one everybody wants to come to me for, right? They want to jump to that. Well, how is your money going to make you money if you're not making the money, right? So I'm not saying that you have to build a scalable business. You can be a highly compensated working professional and obviously take that money and then invest in assets. I'm not saying you have to do that. That's just my truth, not the truth. Now from there, the actual strategy lies in the fact of how we invest the money. So you'll probably hear many people talk about being diversified, investing in ETFs, VOO, QQQ, what may have you. And those are what I like to call a great base and a great foundation. What I like to do, though, is I like to follow a philosophy called core satellite strategy, where I look at the ETFs, right? I want to have that diversification. I want to have that base, but I also want to have the opportunity to invest in individual companies that might have a greater performance, right? And so the way I like to explain it is like what's one of your favorite malls where you're from?
Malls? I like Dubai Mall.
Okay. So I'm pretty sure that's a huge mall. Probably has thousands of stores.
Actually, I hate Dubai Mall, but let's go with that.
Let's go with that. I'm sure it has thousands of stores, right? If 2 or 5 or 10 or even 20 of those stores aren't doing well, do you think Dubai Mall is going to close down? Right, exactly. That's how an ETF works, right? Hundreds of investments inside this one bucket. And some of them might perform really, really well. Some of them might not perform really well. But the benefit is you got to own the whole mall or own the whole ETF. And as a result, the downside risk was minimal to you because you got to own the whole ETF. Now, however, that doesn't mitigate the fact that there are some companies inside that ETF and some companies that are not inside that ETF that are performing really, really well. So the question becomes, how do I get the best of both worlds?
Right.
Let's say you have $10,000 to invest. Maybe $7,000 you invest in the ETF, just press the buy button. You don't have to worry about it. Maybe with $3,000, you do some research. Maybe you even look inside of that ETF. What are the top, you can go to ChatGPT. What are the top performing holdings over the last 5 years in these 3 ETFs, right? They'll tell you, you can look at the trends. Obviously, past performance doesn't indicate future outcome. But in this context, if you feel great about it, maybe with $3,000 of the $10,000, you're investing in some of those individual companies. What ends up happening is now you're not only compounding on the top winners that are inside the ETF, but you're also now owning them individually, which is going to most likely increase your performance, right? And so for me and my clients, we've been able to outperform the market consistently for years by following that strategy.
Mm.
Now, that's just step one. From there, let's assume that of your overall investable assets, some of that money is invested in a taxable brokerage account. A taxable brokerage account allows you to have maximum flexibility. You can invest as much as you want. It's not bound to retirement. And with that, you also can leverage that account. So you can borrow against it. And in doing so, it's a great scenario because now my money's invested. And even if I want to buy another investment, I don't have to sell my existing investments. I can just leverage them and get a line of credit to acquire another investment, right? So now your investment in your investment account is growing and compounding. You got access to a line of credit to buy another investment. And ideally, I'm recommending that investment is a cash flow producing investment, like real estate or acquiring a business that you own but do not run. For those who haven't heard, we're in something called the silver tsunami in the United States, where a lot of people who had, service-based business, laundromats, dry cleaners, car washes, they want to retire. Their kids want to be TikTok influencers. They don't want to own the business, right? And so it creates this great opportunity where the everyday person can potentially acquire that business. Now, saying that out loud sounds like, well, how do I just buy a business? But it's not as complicated as you think. Now, granted, we won't be able to unpack all the nuances on this episode, but conceptually speaking, as a person who's owned something for a very long time, they want to retire too. You can buy that business from them, put an operator in place so that you just own that business and don't run that business. And now you have a vehicle for your own retirement, right? They just didn't know that option existed. They didn't know that they could find somebody else, run the business, still get the cash flow. They've been running the business forever. They just want to get out of it, right? And so we're advising our clients to borrow against their portfolios to buy those cash flow producing assets, which is going to accelerate their wealth building timeline. Because in the States, the traditional ideology is invest your money, let it accumulate, and then when you get to a certain target, you can draw down 4% from your portfolio.
Yeah, I see that a lot.
Right. The challenge with that is, let's say you have $1 million invested. That's $40,000. Now, I don't know about you, I don't know the cost of living in Dubai or where you're from, but like here, $40,000, I don't know if that's going to cut the mustard for most people, right? And most people aren't on pace to even have $1 million in retirement. So how do we bridge that gap? The gap is cash flow. Money is a tool, not a pool. Most people look at money as this pool to accumulate. Let's grow it. Now it's in my bank account or it's an investment account. And then I just maybe at some point draw down from the pool. I look at money as a tool. Because if you reverse engineer the 4% rule, it's not the $1 million. It's the cash flow that you can comfortably get from the $1 million. So if you reverse engineer, are there more efficient ways to get to my cash flow target? You probably can get to your financial freedom target faster. And that's how we advise our clients.
Oh, there was so many good stuff in that. I think one of the first things I really like that you said, what did you call it? The wealth triangle? You invest in you invest in systems and people, and then then
you invest in high return assets. Or your money making you money.
Then your money makes you money. I love that. Just kind of breaking that down a little bit. So becoming world class at something, what does that look like?
Yeah.
What does that look like? Is that like, let's say, for example, if I'm a lawyer in my job, does that look like me becoming the best lawyer I can be? Does that look like me leaving and having my own law firm? What does that look like?
Yeah.
And why do you say that?
That's a great question. To me, becoming world-class is something, whether it's a working profession or whether it's an entrepreneur, all it means is you are relentlessly committed to becoming the best at it that you can be in whatever lane you choose, right? So if you choose the lane of corporate America, great. Like, what is the highest growth track within the role that you are pursuing? If you decide you want to be a financial advisor, how can I become the best? You become the best by becoming curious. And so here's where I think this intersection of passion and profession can come in handy, right? I'm not a big fan of people just telling people to blindly pursue their passion and like pursue what's going to pay the bills and build wealth and then do your passions for free. I think this idea of monetizing your passion, it's not mutually exclusive. If it happens, great, right? But I'm a big fan of do the thing that you can become really good at and make a lot of money from, and then just enjoy your passions. If there's a world where they can merge, that's also great. So becoming world-class is getting curious. It's like, okay, like how do I invest in myself in a way? How do I continue to learn this craft to become better at it? So if you think about sports, Michael Jordan was one of the greatest because he was relentlessly committed to the craft. So reverse engineer who is doing it at the highest level in your industry and what did they do to be able to do that? Who did they learn from? What books did they read? Like what are the things that they did to obtain that skill set? I think people just kind of settle for like status quo. I got the job. I got the business. I'm making enough money to take care of my lifestyle. But like the better you get at something, the more people you attract to yourself. I think Alex Ramosi said it the other day. Is like brand builds leverage because to me, brand is not your colors, it's not your logo. It's being known for what you do, being known for being the best at what you do. And if you are known for being the best at what you do you ever think that getting new clients or getting new customers is going to be an issue? If people buy your sweatshirt and everybody on social media is, oh my gosh, this is the softest, most pillowy sweatshirt I've ever worn. It's amazing. The fabric is perfect. Do you think you're going to have an issue selling that sweatshirt? Probably not. But you have to be relentlessly committed to making the best sweatshirt, right? Maybe you have to buy 100 of them and see what are they doing? What's wrong with it? Maybe you have to fly to where the fabric is made. I don't know. I'm giving extreme examples, but be relentlessly committed to figuring out how can I be the best at what I do? And if you do that, you become world-class. If you do that, making money will not be an issue.
Oh, that is good. That is good. I love that. I want to ask you a question that I've asked a few financial advisors because I love that framework that you've given. But then in terms of if somebody wanted to retire early in their 30s, in their 40s, and when I say retire, I just mean have the option to not work, not necessarily that they are then going to just like live the rest of their life out on the beach. Because some people are like, why would you want to retire so early? What are you going to live? It's like, it's not option. About that. It's the option, right? Yeah. What would you be saying to them? What would you be recommended as a financial advisor? What would you be advising?
Somebody wants to retire in their 30s. What would I be saying to them? Well, first I would say, I would tell them that they would have a disproportionate gap between the money that they make and what it costs them to live. Because it's just the easiest, it's just the cheat code, right? It's like wealth is just a ratio. Even if we excluded investing, if it costs you $50,000 to live your life, and I'm not saying it should cost you $50,000 to live your life, it's probably gonna cost more, but let's just say that it did. For every 100,000 that you have saved, you have 2 years of your life that you don't have to work, right? So it's like, when you look at it in those terms, like, okay, well, how fast can I close the gap? Well, the more I make, and if I keep my expenses at a moderate level, I'm going to be able to just compound and stack more money to be able to get to that target fast. It seems simple, but like that is the first thing I would tell them. The next thing I would tell them is I would focus on cash flow producing assets. Why? Because the easiest way life is always going to cost something, right? Even, especially in America, oh my gosh, like with property taxes and all the things, but life's always going to cost. So the quicker we can have something else produce the money, the quicker we don't have to. Something or someone has to produce it. So just reverse engineering that target of like, okay, I need $5,000 a month to live my ideal lifestyle or $10,000 a month or whatever it is. If I focus on assets that produce cash flow, I can stack that and I can easily see that target. Okay, so far I'm a third of the way there. I'm a fourth of the way there. I'm halfway there. So prioritize cash flow producing assets. It's gonna sound counterintuitive. I wouldn't prioritize net worth first. I actually would prioritize cash flow.
Yeah.
Right? Because here's maybe an interesting dichotomy that most people don't think about. I think time freedom precedes financial freedom. Because if you don't have the time to think and the time to become world-class at something, and you're always busy, right? People who have 2 and 3 jobs never have enough money. It's the craziest thing. You got 3 jobs and you still don't have enough money. It's because you don't have the time to invest in yourself to become world-class, right? So I think that time freedom comes before financial freedom. Now, what is that? What does that look like practically? As you're growing yourself, growing your income, yes, I want you to prioritize investing, but I also want you to prioritize buying your time back, right? Maybe you do get somebody that can help you out with your meal plan or help you out with your meals. Maybe you do get somebody that can help you out with cleaning. Maybe you do get somebody that can help buy back some of the things that's taking away from the time so that you can become better at your craft and then make more money to ultimately become financially free. And most people think it's the other way around. I need to become financially free first and then I become time free. I'll have time freedom. I think you need to buy back your time first and figure out how you can do that incrementally. And for everybody, it's going to look different. It might not look like you snap your fingers and you can hire a full staff to do everything. I'm not saying that. What I am saying is look at the areas of your life that are creating a drag on your productivity. How can I potentially outsource that? Even if it's in business, it's as simple as a virtual assistant so that I can get that time to think, that time to invest in myself, that time to become world-class, because that's when the money's going to come and that's when the financial freedom is going to come.
That's so good. Can you just quickly explain the difference between, because you said prioritize cash flow over net worth. There are some people who are going to be like, what's the difference?
So for example, let's say you buy a really nice house and it's worth $1 million, you owe maybe 400,000, great, right? You subtract your liabilities from your assets, that's your net worth. However, as long as you're living in that house and it's not producing any cash flow for you, that's going to look good on paper, but ultimately you're still going to have to produce income to be able to maintain your lifestyle.
Exactly.
So net worth, we look at it, we see all the time, we look at the Forbes 400 list and it's like they have these really, really big net worths, but a lot of that is paper valuation on the business that they own. And I'm not saying that it's not real. If they sold the business, that money might go into their bank account. But right now, it's not in their bank account. So you can have a really big net worth on paper, but it doesn't necessarily translate to actual tangible money in your bank account. And so the reason why you want to prioritize cash flow is because cash flow is going to be the thing that allows you to pay your bills. And ultimately, if you have your cash flow covered from the investments that you've acquired, then that means you could be financially free. There's people who have really big net worths on paper, but they don't feel free. Right?
On that note, what are your thoughts on property versus stocks?
Great question. I look at stocks as my bank account alternative.
Okay.
Right? Because it's liquid, but the biggest difference is it's going to grow at a much greater rate if you invest the right way in your bank account. Your bank account's not going to give you anything. Maybe your high yield savings account will give you a little something. But for me, stocks are for liquidity and they're for leverage. Right? I don't think stocks are the most efficient vehicle for cash flow. Yes, you could switch to high yield dividend stocks at some point as you get closer to retirement. But I still think when you really just do the math, I don't think it's the most efficient. I do think it's a great vehicle for low barrier to entry. I mean, you have fractional shares, you can invest as little as $10. I think that part of it is amazing. I'm a huge advocate of it for that. And I'm a huge advocate of leveraging it to acquiring other types of assets, right? Because when I have, $100,000 invested in the market, I can then borrow against that, still let that grow, and then go buy other assets like I mentioned earlier. So I'm a big fan for those two premises. I love real estate from its tax advantages, at least in the States. Being able to, buy this asset that has deductions and depreciation that you can take advantage of. I love it from that vantage point. I love it for its cash flow when you buy the right type of property. But it does come with its own host of other responsibilities. Like the stock market, you can log in and in 5 minutes, you can have it set up. Real estate, not so much, right? So I think a nice balance of the two can be great, but also understanding your investing in lifestyle alignment. What I mean by that is you want to invest in a way that is in alignment with the lifestyle that you want to live, because the road to passive income isn't passive. And so if you say, I want to get 100 properties because I think I'm going to get so much cash flow faster, great. But now you're going to have to manage that. I'm not saying that's a bad thing, but you need to know what that looks like in the context of the financially free lifestyle you're trying to live.
Okay, so we are going to be moving on to the Wealth Boy segment. And this is basically where one of the listeners shares a dilemma and they just kind of want your advice. So I'm going to read. This person says, I work a 9 to 5 and earn around 50K. My man is self-employed. He trades crypto and Forex. Over the last year, I invested around 6K with him and he used the returns to invest in property in Africa without ever telling me. I never saw a return. This year, he's asking me to invest more. Should I support? For context, I'm in a long-term relationship. His investment hasn't yielded a return yet. He claims he can recover by trading again. So I want to support his vision and get him to a point where I don't have to lend him money so often. What would you say?
Fool me once, shame on you. Fool me twice, shame on me, right? So, I mean, at the end of the day, when you're investing any dollar, there needs to be transparency, right? Regardless of the context of the relationship. And I think that the fact that he invested, even if he was successful with the investment, maybe I'd have a little bit more leniency. But the fact that he wasn't even successful, you're going to pour more money into it. And I don't think that's a good idea. So what I would do is I would cut my losses on both the investment and the relationship.
Oh, not going to cut the relationship to why?
He took her money.
She gave it to him to invest.
Well, she gave it to him to invest in crypto, from what I'm hearing.
Yes.
Then he took the money and invested in real estate.
Yeah.
And then he didn't get a return on the investment. So the investment didn't do well. So that I can think that's at some point he should have said, hey, I want to take the profits from the crypto. I think there's another amazing, he should have got her buy-in, right? And then at that point, if it didn't do well, different story, right? It's like, hey, I do believe in you. I want to try again. But he didn't even tell her. She didn't even have the choice. So maybe it was a little bit extreme to say cut the relationship. But I will say it's
a red flag.
It's a red flag for sure. And I'll be cautious on investing again. Right.
Yeah, I mean, main job is investing in crypto and Forex, which is pretty high risk. A lot of people, exactly. A lot of people can do it, and I would say that the majority of people who do it are largely unsuccessful, despite what social media shows us. I think there's a small group of people who do it and who do it well. Yep. A lot of people, they think they're investing in Forex and then they're actually investing in an MLM scheme and all this other stuff. Right. So it's high risk. Investing in Africa can also be very high risk as well, especially if you don't have that oversight of what's going on. I mean, you've invested in Ghana. I've invested in South Africa. Like, I'm not saying don't invest in Africa. You definitely can. But like, if you don't even know that your money's going there, then you don't even know where the investment is going to. Yeah. I would agree. It's a
lot of moving parts, right? So first things first, don't invest another dollar. Second thing, I got some things to get clear on with the trust and transparency of that relationship. But I'm no relationship expert, so don't take my advice on that.
Agreed. So we are going to be moving on to the quick fire money question. So this is 3 questions and I would just love for you to tell me the first thing that comes to your mind. Sure. So the first question is, what is the best investment you've ever made?
The best investment I've ever made was myself.
Every single guest is the same answer. Elaborate or give us something else.
Okay. Elaborate. Okay. I mean, I think, at least in my defense, that has been a theme of our interview today, right? The reason why investing in myself was the best decision I made because it allowed me to build what I have now. If I didn't make the investments in myself by hiring coaches, hiring mentors, reading books, and continue to pour into myself, I wouldn't be the version of myself that could handle or even conceptualize what I built now, right? So essentially, without that investment, none of the other investments would have happened, at least not at the scale that they're happening right now.
Okay, what's been your best monetary returning investment?
Best monetary return in an investment? I think probably Apple stock. I bought it like in 2000. I still hold it actually. I bought it, my first lot of shares in 2009, maybe 2010. And I've been holding it ever since.
Wow. That's...
So that's probably what up there. A more recent one is I bought Palantir at $6. And now I dropped a little bit the past couple of days, but I think now it's like $140 a share. I bought a decent amount of shares. So that was a substantial upside for sure in the past couple of years.
I love that. Okay, next one is, what is your biggest money mistake?
Biggest money mistake? Oh, this is easy. Now, this one I do have an answer for. In the pandemic, there was this guy promoting automated Amazon fulfillment store. I was like, oh my gosh, that looks great. I can buy into that business. It was the worst decision of my life. Worst business or financial decision of my life. And not because of how much money I lost, but because of all of the mental drag that came with unraveling the investment. Terrible. Because they registered me in every state. And so that means that like I had a tax responsibility in all those states, even if I didn't transact business there and they were supposed to manage it, they didn't manage it. And it took me so long to like unravel. It was just a nightmare. Worse is the lesson in that. If someone says it's automated, it's automatically BS. That's the lesson. You automated this or no. No. It doesn't work that way. The world doesn't work that way. It's probably BS.
Did you make any money from it?
No.
That's that's a money mistake. Okay. And then finally, what is one piece of advice you'd give to someone who's trying to build wealth?
One piece of advice, man, you got to distill it down to one. I would have to say, man, that's hard because I have so many things I want to say.
Okay, do two.
No, I'm gonna take the challenge. I'll pick one. I would say that the same fire that can keep a house warm can burn it down.
Ooh.
And what I mean by that is when you become world class at something, or when you decide to pursue becoming world class at something, you have to understand both sides of the equation, right? So, for example, you'll hear like when people are dating or something, they'll say, "Oh, he's so ambitious," and then it turns into he never has time for me, right? Or he's so funny. You think everything is a joke, right? So I would be cognizant of having self-awareness in your pursuit of whatever it is that you want to pursue in building wealth or building your business, and make sure that you understand the other side of the equation.
Ooh.
And then if I could piggyback that, I know I said I was going to stick to the rule, but I think it's something that's really important too, is you can live in the house while it's being renovated. Oftentimes we feel like we have to wait until things are perfect before we launch or before we build or before we do. Like you can live in the house while it's being renovated. Like do not wait. Like your obedience is tied to somebody else's destiny. They're relying upon you to start where you are and to use what you have and to do what you can.
That is so good. That's one of my favorites of the responses to that answer. That is so good on so many levels. And that is the perfect place to wrap up. This has been so good. I do wish we had more time, but if they are looking for you, they want to find out about Melanin Money. That really,
you had it right the first time, Melanin Money.
Yeah, whatever. Yeah. Where can they find you?
Yeah. So on Instagram, I'm pretty active. George Acheampong Jr. I'm sure to be in the show notes. Melaninmoney.com or Melanin Money everywhere else. YouTube, Instagram, online. You'll find us.
I love it. Thank you, George.
Thank you for having me.